When a billionaire goes to buy a $700 million yacht, do they need to sell stocks or do they have that money in their bank account? You might be surprised to learn that billionaires and their families typically conduct banking transactions at many of the major private banks in the US. But where and in what would someone trust to store their $191 billion? More than 56 million people are millionaires, and 2,640 are billionaires worldwide. The United States leads with over 21 million millionaires and 735 billionaires, making it the top destination for the wealthy. Additionally, countries like China, India, Germany, and Russia also have a significant share of the world's richest people. While the number of millionaires has significantly increased compared to the last century, the value of $1 million has also lost some of its former magnitude. In simple terms, $1 million doesn't have the same purchasing power it used to have in the 90s. However, it's still a considerable amount. The financial and personal habits of high-income individuals have always fascinated the masses. Many people try to emulate these habits in hopes of achieving similar results. While it works for some, for others, it doesn't yield the desired outcomes. The disparity between the truly wealthy and the masses lies in how they organize their assets and wealth. While most people tend to keep their assets, whether they are properties, stocks, or even artworks, in their own names, the truly affluent opt for a more strategic approach. They avoid direct ownership of their assets, preferring instead to place them under the umbrella of companies, trusts, and foundations. By doing so, the assets become the property of these legal entities rather than the individuals themselves. This distinction has significant implications, especially in terms of taxation. While an individual is taxed based on their gross income, companies and trusts are taxed after deducting liabilities and operational expenses. This substantial difference in tax structure can result in considerably lower tax burdens for the truly wealthy compared to those who hold their assets in their own names. Furthermore, this structure allows for remarkable flexibility regarding lifestyle and spending. For example, expenses that might be seen as luxurious or personal for ordinary individuals can easily be framed as business or corporate expenses for those who organize their assets in this way. Flying first class to visit friends abroad can be categorized as a business trip. Dining at expensive restaurants with friends can be considered as business entertainment costs, and even buying a new car can be accounted for as a company asset. If you enjoyed this, please subscribe to the channel. The structure of foundations offers unique opportunities for tax optimization, especially in contexts where certain activities are eligible for tax deductions. In many parts of the world, such as Singapore, donations of art to specific institutions can qualify for significant tax benefits. What makes this strategy particularly interesting is when the foundation in question is owned by you, opening up space for savvy moves that can result in substantial tax deductions. Consider the following scenario. You acquire an artwork directly from the artist for $1 million. Subsequently, through an appraisal conducted by an appraiser of your choice, the value of the artwork is increased to $5 million. At this point, you decide to donate this artwork to a foundation that you have created or to which you are a major donor, and which is linked to a museum or cultural institution. Depending on local legislation, this donation may result in a tax deduction that can amount to 3 times the appraised value of the artwork. Thus, in the mentioned example, your donation of an asset that cost $1 million could generate a tax credit of up to $15 million. This savvy maneuver not only results in considerable tax savings, but also allows you to direct resources to causes and institutions that you value. But the possibilities don't stop there. At a more sophisticated level, you may, at some point, plan for the foundation to gift you the same artwork in recognition of your community service. This gesture not only solidifies your legacy as a philanthropist, but also creates an opportunity to host fundraising events, such as a gala dinner where guests are encouraged to contribute to a charity that you have initiated. These additional donations not only strengthen your social impact, but can also generate more tax credits for future activities. Assets in companies and trusts are protected against bankruptcy proceedings and asset seizure by creditors. Assets in trusts are confidential, unlike companies, and you do not need to disclose them. Company assets may need to be disclosed, but there are ways to conceal things in plain sight. Assets in companies and trusts are also shielded from asset seizure and claims in disputes and bitter divorce proceedings. The problem with prenuptial agreements is that they cannot cover everything, and the determined person may find ways around them. You have to prove that each item is not a marital asset in some cases. But assets in your irrevocable personal trust are considered to belong to a distinct entity, the trust. This despite the fact that you may be the settlor, the sole trustee, and the sole beneficiary. It's you gifting to yourself. Another asset class that the wealthy prefer over ordinary people are insurance policies. Specifically, insurance policies that are linked to investments are highly valued by the financial elite. While most people may be familiar with traditional insurance plans offered to the general public, the wealthy opt for more sophisticated plans tailored to their financial needs and goals. A fundamental aspect of these investment-linked plans is the ability to integrate high-performance investment strategies with high net worth insurance coverage. In essence, these plans offer an effective way to grow wealth while ensuring financial security and asset protection. A practical example illustrates the difference between an investment-linked insurance plan and a traditional plan. A wealthy individual may choose to acquire a plan with an annual premium of $12,400. However, the coverage stated in this plan may seem modest at first glance, for example, $100,000 in case of death. However, the real benefit of this type of plan is the ability to supplement basic coverage with substantial investments. Here's the trick. The stated value of the insurance coverage does not necessarily reflect the total potential of the plan. In fact, an investment-linked plan allows the policyholder to significantly increase the invested resources, provided they can provide evidence that the funds have a legal origin as required by the KYC, Know Your Customer process. Therefore, the seemingly modest insurance plan with a nominal coverage of $100,000 can, in reality, shelter millions of dollars in investments. This flexible structure offers high-income individuals the opportunity to significantly expand their wealth while enjoying the additional benefits of financial protection offered by insurance. In some parts of the world, some insurance companies allow withdrawals from investment-linked plans to be in the form of checks, and they can be sent to any location you specify as a mailing address, perhaps even to a neighboring country. This check is then cashed in that country, and you effectively move money without going through the banking system and without scrutiny. Furthermore, there's a range of investments, which, as you can imagine, differ from ours, where individuals with a net worth of $30 million or more, including their primary residence, allocate their wealth. Stock investments accounted for nearly 20% of the wealth of the ultra-rich, with investments in the Americas holding the largest share of equity wealth, 33%, followed by Europe, 28%, and Asia, 26%. Private equity and venture capital investments, which include investments in startups that have not yet gone public, averaged 6% of total wealth. This strategy is intriguing because much of a company's growth occurs in its early stages. So when these institutions go public, their growth potential becomes much less pronounced than it was up to that point. In 2022, there were approximately 579,000 people worldwide with wealth exceeding $30 million. New York, Tokyo, and San Francisco are home to the wealthiest individuals in the world. Over the next 5 years, this number is expected to reach 744,000, a 29% increase. As these numbers continue to rise, the demand for luxury real estate, stock investments, and luxury items will likely grow. The wealthy and the masses understand finance differently and are effectively playing a different game. It's worth reinforcing that none of the above is illegal. But if a billionaire, instead of investing their money, decided to donate $1 million to each person? If you liked this video, please support the channel in the first pinned comment. Until next time.